The year is 2026. A new chapter unfolds in the story of Australia. On the surface, Australia still looks like the lucky country, a land of opportunity and prosperity, endless sunshine, pristine beaches stretching as far as the eye can see, and bustling cafes filled with the aroma of freshly brewed coffee and the chatter of friends. But beneath this idyllic facade, a deep economic malaise has taken hold, casting a shadow over the nation's future. This isn't a sudden crisis, but rather the result of decades of policy choices, both good and bad, compounded by global shifts that have reshaped the economic landscape. Stagnant wages are now the norm for many Australians, a harsh reality that contrasts sharply with the rising cost of living. This wage stagnation is eroding purchasing power for millions, making it harder to afford even the basic necessities. The cost of living climbs relentlessly, putting immense pressure on household budgets. Meanwhile, pay packets remain fixed, creating a growing disparity between income and expenses. The most visible symptom of this economic strain is the housing market. Once a symbol of security and the Australian dream, it's now a source of anxiety, division, and profound inequality. House prices in Sydney and Melbourne, the nation's largest cities, remain stubbornly disconnected from average incomes, creating a significant barrier to entry for first-time buyers. This disconnect is creating a chasm between those who own property and those who are forced to rent, often paying exorbitant prices for inadequate housing. The dream of home ownership is slipping away for an entire generation, leaving many young Australians feeling disillusioned and uncertain about their future. Compounding this housing crisis is a mountain of household debt, a burden that weighs heavily on families across the country. Australian household debt is among the highest in the developed world, making the nation particularly vulnerable to economic shocks. Low interest rates, once seen as a boon, encouraged massive borrowing, fueling the housing boom and driving up debt levels. But as interest rates inevitably rise, this debt becomes a heavy anchor, dragging down economic growth and putting families under immense financial strain. High levels of debt restrict spending, as families prioritize debt repayment over discretionary purchases, stifling investment and economic activity. This leaves families vulnerable to economic shocks, such as job loss or unexpected expenses, pushing them further into financial hardship. The easy credit that fueled a consumer boom in the past, creating a sense of prosperity and abundance, is now a significant source of fragility, threatening the stability of the entire economy. Meanwhile, our trade relationship with China, a partnership that has been so crucial to Australia's economic success, the engine of prosperity for 2 decades, driving growth and creating countless jobs, is now sputtering, facing new challenges and uncertainties. Demand for our resources has cooled, as China's economic growth slows and its focus shifts to other sectors. Furthermore, the geopolitical landscape is more complex than ever before, with rising tensions and shifting alliances creating new risks for Australian trade. The result of these factors is a collapse in our terms of trade, as the prices of our exports fall relative to the prices of our imports. This decline in trade revenue is shrinking government revenues, making it harder to fund essential services and invest in the future. Ultimately, these economic challenges are affecting every Australian, from families struggling to make ends meet to businesses facing uncertain prospects. The pillars that once held up our economy, providing stability and prosperity, are now shaking, threatening the foundations of our society. The Australian housing bubble wasn't an accident, it was decades in the making. It's a story of escalating prices, fueled by a complex interplay of factors that have transformed the dream of home ownership into a precarious balancing act for many. Government policy played a significant role, with decisions and regulations shaping the landscape of the housing market. These policies, while often intended to stimulate growth, inadvertently contributed to the inflationary pressures we see today. Cheap credit, readily available and easily accessible, further fanned the flames. The low cost of borrowing encouraged greater participation in the market, driving up demand and pushing prices higher. And let's not forget a deeply ingrained cultural obsession with property. Home ownership is often seen as a cornerstone of the Australian dream, a symbol of success and security, further intensifying the demand. Policies like negative gearing, allowing investors to deduct losses from their rental properties, and the capital gains tax discount, reducing the tax burden on profits from property sales, turned homes into speculative assets, incentivizing investment over owner occupation and further distorting the market. The Reserve Bank slashed interest rates to historic lows in the wake of the global financial crisis, aiming to stimulate the economy. And then again during the unprecedented challenges of the COVID-19 pandemic, making borrowing cheaper than ever before and injecting even more fuel into the already overheated housing market. Banks, eager to capitalize on the booming market, offered massive mortgages with increasingly lenient lending criteria, and buyers, gripped by the fear of missing out, FOMO, took on huge debts, often stretching their finances to the absolute limit. Median house prices in major cities became increasingly detached from average wages, creating a widening gap between the cost of housing and what the average worker could afford. Now, in 2026, the chickens have come home to roost. The housing bubble is no longer a distant threat, it's a ticking time bomb, threatening to detonate and send shockwaves through the entire economy. High interest rates, implemented to combat rising inflation, have made servicing mortgages increasingly painful, placing immense pressure on household budgets, pushing many families and individuals into mortgage stress, where a significant portion of their income is dedicated solely to keeping up with their home loan repayments. Consequently, consumer spending has chilled, as people prioritize mortgage payments over discretionary purchases. As households struggle to keep up with repayments, forcing them to cut back on essential goods and services, further impacting the broader economy. The financial system is heavily exposed to the property market, with a significant portion of its assets tied to the value of residential real estate. The Big Four banks' loan books are overwhelmingly built on mortgages, making them particularly vulnerable to any downturn in the housing market. A sharp fall in house prices, triggered by rising interest rates or a change in market sentiment, or a wave of defaults as borrowers struggle to meet their repayments, could trigger a credit crunch as banks become more risk-averse and restrict lending. Household wealth would be wiped out as property values plummet, leaving many homeowners in negative equity, owing more on their mortgages than their homes are worth, further dampening spending and creating a vicious cycle of economic decline. Banks would tighten lending standards even further, making it harder for businesses and individuals to access credit, starving the economy of the lifeblood it needs to function and grow. The housing market is no longer just a market where people buy and sell homes. It's a systemic risk, a potential point of failure that could bring down the entire financial system. The consequences of a housing market collapse could ripple through every corner of the economy, impacting jobs, businesses, and the overall standard of living for all Australians. For young Australians, the economic landscape in 2026 is bleak. Generation Locked Out faces impossible odds, soaring house prices, stagnant wages, and insecure work. Saving a deposit is laughable when median house prices are 12 to 15 times the average salary. Most jobs are casual or gig-based, making mortgages out of reach. Student debt is high, growing with inflation, and delays major life milestones. High rents and low wage growth create a cycle of financial struggle. Intergenerational inequality is growing, fueling resentment and a sense of injustice. Mental health issues and political disillusionment are on the rise. The social contract promising a better future feels broken. For nearly 2 decades, Australia enjoyed unprecedented economic growth. This prosperity was largely fueled by a single, powerful engine. Australia's prosperity was inextricably tied to China's seemingly insatiable demand for raw materials, particularly iron ore. Our fortunes rose and fell with theirs. This demand was primarily for our vast resources, transforming Australia into a global powerhouse of resource extraction. The resulting mining boom masked underlying cracks and vulnerabilities in our broader economy. It created a reliance that would later prove problematic. It delivered substantial windfalls, boosting government revenue and fostering a widespread sense of economic security and invincibility. But as we moved into the early 2020s, the global economic landscape began to shift dramatically. China initiated a strategic shift, moving away from its previous model of debt-fueled construction and infrastructure development. The goal was to transition to a more sustainable and balanced economic model, prioritizing long-term stability over rapid expansion. Consequently, economic growth in China began to slow, impacting demand for resources worldwide. Compounding the issue, a significant crisis emerged within China's property sector, sending shockwaves through global commodity markets and causing prices to plummet. The price of iron ore, the lifeblood of the Australian economy, collapsed dramatically, triggering widespread concern. This collapse punched a significant hole in our national income, severely impacting government revenue and economic forecasts. The federal budget, which had once been comfortably buoyed by consistently high commodity prices and resource royalties, suddenly plunged into a substantial deficit, forcing difficult decisions and austerity measures. Mining investment, once a driving force of the economy, rapidly dried up as projects were cancelled or postponed. This downturn led to significant job losses across multiple sectors, particularly in mining-dependent regions and related industries. The Australian dollar weakened considerably against other major currencies, reflecting the diminished economic outlook. This weakening made imports significantly more expensive, impacting businesses and consumers alike. The increased cost of imports further exacerbated the already challenging cost of living crisis, placing additional strain on households. Our over-reliance on a single customer, China, left us particularly vulnerable to these global economic shifts and downturns. The economic slowdown rippled through the entire Australian economy, impacting businesses, industries, and communities nationwide. From the remote mining operations in the Pilbara region to the bustling financial districts of Sydney, the impact was felt across the country. In many ways, we bet the house on China's continued growth and demand, banking on a relationship that seemed unbreakable. And now, as the tide turns, we're facing the economic consequences and paying a significant price for that dependence. The end of the mining boom exposed Australia's lack of economic diversification. Dutch disease hollowed out manufacturing and made other exports uncompetitive. The boom created a skills mismatch and left us with stranded assets. Wealth from mining was unevenly distributed, deepening social and economic divisions. Political leaders grew complacent, avoiding tough reforms. Instead of investing in future industries, we spent the windfall on short-term gains. Now, with the boom over, we're left exposed and unprepared. The storm has hit and we have few economic levers left to pull. Canberra's response to the crisis has been political paralysis and a lack of vision. Both major parties avoid tough reforms, fearing voter backlash. Housing policy is contradictory. Measures like first home buyer grants only fuel demand. Tax incentives like negative gearing remain untouched. There's little appetite for nation-building investment in infrastructure or innovation. Australia drifts, lacking a coherent long-term economic strategy. Australia's economic struggle is a story of debt, households and government both drowning. High household debt, driven by massive mortgages, makes families sensitive to interest rate hikes. Consumer spending contracts as more income goes to repayments, driving stagnation. Banks are exposed. Rising unemployment could trigger defaults and a credit crunch. Meanwhile, government debt has ballooned, crowding out essential services. Fiscal constraints leave little room to stimulate the economy. We face the storm with a depleted national treasury. The true cost of economic malaise is the fraying of Australia's social fabric. The housing crisis has created geographic segregation and deepened inequality. Essential workers are pushed to the fringes, straining communities and infrastructure. Financial stress drives mental health issues and isolation. Political polarization and distrust in institutions are rising. Economic hardship is testing the resilience of our democracy. Australia's challenges in 2026 are not a temporary downturn. They're structural. The old model housing boom's high debt and resource exports is broken. Productivity growth is stagnant and our economy lacks diversity. Intergenerational inequality is entrenched. Solutions require political courage, tax reform, and investment in education and innovation. We must build new industries and a fairer system. The choices we make now will shape our future. The lucky country's prosperity is no longer guaranteed, it must be earned.